Hello and welcome to Making Retirement Make Sense. I'm your host, CJ Miller, joined today by co-host Dana Onspa. Dana, how are you?
I'm doing great, CJ. Glad to be here. Excited about this conversation today.
Me too. Today, we're going to be talking about one of retirement's biggest landmines when handled incorrectly, and that is handling concentrated positions. And what we find often in our profession is that a lot of people, as they prepare to retire, well, they've accumulated wealth through concentrated positions. And maybe that is, business ownership, maybe that's some real estate investment, or just they got lucky picking, an individual stock. And there's a whole host of nuances that go into that as they start to transition into retirement. And so, Dana, I'm curious, in your view, for retirees, how much of a concentrated position is too much?
Oh my gosh, that's a hard question to answer. And, when you were talking about the ways people accumulate concentrated positions, one of the common ways is just through their employer. They work for a publicly traded company, they're granted stock options, they're granted RSUs, performance stock units, stock grants of some kind, options of some kind. And so over the years, not only do they have a large position in a concentrated stock, but their income comes from that same company. And so that is a tremendous amount of risk that happens when you accumulate this. And I completely forgot the question you asked me, CJ.
It was, how much is too much?
How much is too much? Yes, thank you. The standard rule of thumb on how much is too much is 5% of your portfolio. But I would say, in reality, that can be unrealistic when you're in the accumulation mode. Most people who have accumulated a concentrated asset aren't selling it off quickly enough to keep that total exposure to 5% of their portfolio value or 5% of their net worth. And so I see anywhere from, I've seen people that have 80% of their wealth in a concentrated position, which is terrifying to me, absolutely terrifying. And our goal is to try to whittle it down, not necessarily to a set percentage, but more to a, where is that risk level where it could totally wipe them out in retirement or really pose a significant change to their retirement lifestyle. And I know you have had a really unique way of modeling that kind of risk that I just love. Do you want to share a little bit about that?
Yeah, well, absolutely. I mean, I think with any kind of investment, really what you need to be thinking about is the risk versus reward. And with any individual position, you have to understand, well, what is at risk and how do I identify what the reward is? And so the very first question I will ask in these positions is, well, do you need the money? Like if you're going to retire, our whole focus is decumulation. And so if you're looking at your plan and you're in a position where, let's say you have $5 million in individual stock and it's 90% of your assets, but you barely spend anything. Well, maybe, right, you can retain more risk of that equity, right, than not. And so that's kind of the first place to start is let's start, identifying what is the goal that you're trying to achieve. And then by maintaining the stock or whatever the position is, what does that look like? And we can get into the nuances there in a little while when we start talking about strategies of how to deal with it. But you mentioned that the client that had 80% of their investment in one thing. Why does that scare you?
It scares me. I remember, so I had just moved here to Arizona. I worked for a CPA firm, and it was a client of the firm. Intel has a location here, and this person was an Intel employee, had about $10 million of Intel stock, and it was really all their wealth, the majority of their wealth. They had a property, a piece of real estate, and some other savings. But you can live really comfortably off of $10 million, right? And we watched that stock, it was 2001 to 2002, go down by almost 80%. I think Intel went from, I didn't look up the pricing before this, but probably from about 100, eventually down to like $20 a share. That's just such a significant difference. So when you talk about like, do you need the money, right? They could have lived off of this asset comfortably for the rest of their life, and they were still going to be comfortable at $20, $30 a share, but not nearly as comfortable as if they would have diversified when it was at a higher price, which we, talked till we were blue in the face to try to get that diversification to happen. But people get an emotional attachment sometimes to, that employer, that stock that helped them accumulate that wealth, and they just something obstructs them from wanting to part with it. It's hard to be rational. I see that many times. I've seen that.
Absolutely. Well, and you bring up such an interesting point. When we talk to clients that have these large positions, they almost never are in a position where they're making calculus rationally. Like they're not building a discounted cash flow and saying, "Well, I think the stock is worth X, but actually it's worth Y, so I'm going to, maintain the exposure." It's almost always the opposite. They're looking at it and for whatever reason there's a bias that's stopping them from selling it. Right? It could be they don't want to pay capital gains tax. That's huge. It's a big reason right now that we see with many of our clients. It could be just because of recency bias, right? They're in a position where they say, well, you know what? We have, a stock that's done really well over the last decade. Why would I ever sell it? Apple, everybody buys an iPhone. Why would I ever sell it? But the stats very clearly show that once a stock is in the top 10, it almost never stays there over long periods of time. And so you're right, even if you can retain the risk of that particular holding, it doesn't mean that it's going to lead to the best outcome. Oftentimes it won't. And so there's like the catastrophic risk, but there's also just underperformance risk in general, right? And really what you want in retirement is to maximize stability, not your overall rate of return. And so I always posture the question like, well, what if that $10 million Intel position turned into 30? Would it really have changed their lives as much as losing 80% of it? Probably not. That's a great case of risk is not really worth the reward in retirement. And what we find is when clients maximize stability, when they sell those positions, I've never seen a client sell a big position and then call me a year later and like talk to me about the stock price. They always forget about it the second it's off their balance sheet. And I think that just speaks to the real goal of people in retirement.
Yeah, and I think it's often a fear, some kind of irrational fear that can take over us. I've seen it particularly if people were raised in poverty or, they didn't have a comfortable upbringing. And so there's this fear that it will all go away and they need to retain this stock because, it just that somehow there's some kind of subconscious thing tied to it. So that can get in the way of making rational decisions. And maybe it's just not understanding the risk return trade off. I was reading through some of the research reports that you pulled together, and it was astonishing to see the actual statistics. I think it was 20% of stocks, maybe it was 21% over time have outperformed just a broad-based market index. So only 1 out of 5 stocks, and that was including stocks that were delisted for various reasons and stocks that stayed listed, but they just didn't outperform owning the index. So those aren't great odds to, I don't think I would go to Vegas and bet if I had a 1/5, 20% odds of winning against simply owning a diversified portfolio.
No, absolutely not. And this is why conceptualizing the risk is so hard because we're taught standard market norms, right? That like time in the market's more important than timing the market. And the idea that if you're in a position where you have more time horizon or, oh, I've got 10 to 15 years for that particular tranche of assets, I can basically just let it ride and I'll have a good expected return outcome. That's not true for individual stocks. It's actually quite the opposite. Most stocks, the longer you hold them, the more they underperform, not overperform. And to the degree where a lot of stocks actually go bankrupt. There was a study by Hendrik Bessenbinder, a PhD at ASU. He wrote one of the most fascinating papers I've ever read. Every investor should take a look at the high-level details of this study. It basically looked at market returns from 1926 to 2016. So you're talking about almost a century of market outcomes of the U.S. market. His findings are 4% of all stocks accounted for 100% of net wealth creation from that time. And so back to the 1 in 5, that may be over a 10-year period or a 20-year period, but over the history of the market, it's only 4%. So much so that just 90 companies were responsible for half of that wealth creation. So returns are not normally distributed, right? They're very concentrated, and that's why you can't use averages when you're looking at individual stocks.
Yeah, and I think the challenge is people think they have one of those 90 stocks, right? So they might hear those stats and go, great, I just need to find that 4%, but that's almost impossible. In that same report, I think I was reading the summary and it was like 57% some of stocks, 1926 to like, I think it went through 2018 or 2019, hadn't outperformed T-bills. And so that just took me back. I was like, wow. So, if I was picking individual stocks and happened to get a basket of those that didn't outperform T-bills, I didn't do very well. Versus if I owned the whole market, I had much better odds of, as you said, bringing some more predictability, the potential for more consistent returns over time. And that's where I think people just don't understand the risk. They don't understand that a company can't maintain a certain growth rate forever. It might go on a good run, but it will eventually level off or go through a time period where its earnings aren't as strong or it's not performing as well. That's just the natural business cycle. And the business cycle for an individual company does not always align with the market as a whole.
That's absolutely right. And, it's almost like we're rooted in two emotional biases when we make investment decisions. And most people are like this, right? There's anchoring bias. And that is when you have a concentrated position and you maybe bought it at $100 and now it's at 80. And you're like, I'm not going to sell it till it's back at 100. We see that all the time.
Yes.
But then there's also recency bias. And that is, I own NVIDIA stock, as we record this. And you say basically, well, it's done so well. Why would I ever sell it? It's going to keep doing well. And neither of those are, financially prudent ways to make that decision, right? It's not to say there's no merit in buying or, selling, but ultimately you're putting yourself in a position where you're not really in the driver's seat. And if that stock goes down, you switch from that recency bias straight to the anchoring bias, and it prohibits you from making a good decision.
Yeah, and I've also seen people who look at their company and they may say, okay, well, I know my company's getting ready to roll out X. And so I'm looking at other companies that have X, and I'm just sure our earnings are going to grow to this degree and it's going to impact the stock price. And their company may in fact roll out X just as they thought, but they don't necessarily know what the competition is doing or what the rest of the market is doing or what the economic cycle is going to be. So I have seen executives work for companies and exactly what they said was going to happen in terms of the product rollout, but it just didn't impact the stock price the way they thought it would. And so that's another form of bias. You're in that company, you're seeing what's happened. I think we would call that overconfidence bias, perhaps, right? You're just super confident that you know what's going to happen. And in those cases, I have seen people who just aren't comparing it relative to the index. Like, it's in their mind, their stock is the only game in town, right? Like, that's the only way to earn good returns is to hold the stock, not realizing, hey, we're not going to sell this stock and put it all in cash. It's going to go into something else that also has potential, that has strong potential over time. We're not just going to, park it under the mattress. And so people forget that there are other ways to achieve significant returns that can make a difference in their portfolio. And somehow it's like they have blinders on just related to that individual stock.
And the challenge, I think, is you have to be right twice. If you recognize that, okay, most stocks will have a trajectory where maybe they have a run up and then they have a huge drop off or they just stabilize and never, quite catch back up. That means you have to be right that, yes, you were right that there's a run up in the stock. And now you have to be right when you're going to exit it, right? Once you recognize that, because holding it forever, the odds are you're not in your favor. And that's just incredibly hard to do, ultimately. And the other hard part is something you mentioned that I loved was the idea that there are external factors that impact that stock price that are unforeseeable. And just like we talk about how the biggest stocks make the biggest driver in returns, what's also true is that the biggest, the best and the worst days in the market by magnitude impact any individual stock. And so the best and worst days in a stock's history will make up a large portion of the outcome. How many people pre-COVID thought movie theaters were going to be empty so quickly, right? But they absolutely were. That kind of disruption, it's built into the American economy. I think that's frankly a good thing long-term. You don't want the same companies ruling the market for, decades at a time. That's not very competitive. But it's never really been that way. There's another study we have. It's from Dimensional Funds, and it's super interesting. The title is, Will the Magnificent Seven Stay on Top? And what it lists is the top 10 companies by market cap from 1980 to 2025. And when you look at the list from 1980, here are some companies. IBM was the largest company. AT&T, ExxonMobil, General Motors. It's a lot of energy. People think tech today and they think, well, why would I ever invest in anything other than tech? And the answer is because sectors are cyclical too. And we're not really sector investors. We want to capture broad exposure to all economic type outcomes. But you can't ever assume that just because tech has been winning for so long, that's going to maintain, for the next 20 years. And in fact, the odds are it likely won't.
Yeah, and I've seen the same with, looking at the stocks that are in the Dow versus, today versus when it originally came out. The stocks that are in the S&P 500 today versus even 10, 20 years ago. Those stocks change. The winners cycle up and down, and it's why we're such fans of owning the whole market, right? If you think about how capitalism works in itself, collectively, there's going to be people who are always going to capitalize on the latest market trends, the latest, demographic sectors, the latest technology and products. And many of those companies are going to go public and they're going to be available for us to buy. And if you just own collectively all of them, yes, you're going to have the winners with the losers, but collectively, we believe capitalism works, and over time, you should see respectable returns from owning a broad basket of stocks. I've also used the analogy that, when I think of retirement, I think of this range of outcomes, right? Like we want a minimum floor, a minimum outcome that would allow someone to live the lifestyle they want for the rest of their life. And if we build things in a certain way, we feel real confident that it's going to come out within that range of outcomes. As you start deviating from that, as I start looking at having 30% of a portfolio in a single stock, suddenly I become a lot less confident that reality is going to come within this range of acceptable outcomes. Sure, maybe there's the potential that reality could look even better than these potential outcomes, but there's also the potential that reality could look even worse and that someone could be in a truly catastrophic situation where they had to go back to work, where they had to substantially cut their lifestyle, downsize, and that's not something you want in retirement. You want to avoid that, and that means really changing the way you think about risk and the outcomes that can happen.
Absolutely. And it's almost like you need to focus on outcome and not speculation.
Yes.
Right. And I think that helps people overcome those emotional biases, because when you're looking at selling the stock and you're comparing it to what you think the price might be a year from now, that's not really impactful. When you're comparing it to what you're going to secure from an outcome standpoint in retirement, it makes it a lot easier to make a prudent decision and to, basically sever those emotional ties. And the best stock pickers historically, not that there are many good ones, just by track record, you could say they're lucky, but the best ones are always typically emotionless about the stocks. They're happy to sell when the prices hit their targets, right? They
Yes.
don't ever feel like they need to hold on for too long. Retail investors almost never do that.
Yes, and I have encountered clients like that too, and I'm always so impressed. We'll say, look, we recommend you sell, 10% of this stock right away, and they're like, done. And we're like, what, really? Because I've had many others where I feel like it's a tug of war, right? Like I'm trying so hard to help them do what's best for them. I had one and they had a lot of options and I created this model. So there's something called the Black-Scholes options pricing model. And basically it's about leverage. So if you think about leverage like a lever, the longer the lever, right, the less force you need to move an object. Well, if you think about stock options, there's a similar, mathematical impact at work. So if you have a grant price and you can buy stock at a certain price, well, when the stock is now 2 times that grant price, that's your maximum amount of leverage. And as you hold the stock past that point, the amount of leverage you have decreases. I think of it as you're actually, have far less potential return for the risk you're taking. You now have more downside than upside. And I'm very visual, so I can hear all of this, but I actually had to create this graph to kind of show this curve of leverage and then how it flattens off at a certain point to say, look, there is absolutely no point to keep holding this stock past this point. But no matter what I tried, I was not successful in that particular case. And it all turned out fine in the long run. But, it's interesting to see sometimes how much effort we can put into trying to really tell someone why we are making a certain recommendation.
Yeah, I mean, ultimately, it's the client's plan, right? And so that's the hardest part. It's their money, and ultimately, they are the final decision maker. And all we can do is our best to, just use our, industry knowledge and our professionalism to say, okay, these are the outcomes that we've seen through decades of experience. And I think that's also one of the benefits we have. So if we line up, say, 10 executives and they all work at a Fortune 500 company, all 10 of them want to keep exposure to their stock. There's not one that raises their hand and says, my company is going under. We need to sell everything immediately, right? Almost always they're saying, I want to, continue my exposure. I want to delay exercising my stock options. I think, the next quarter is going to be our best ever, right? It's in a way to motivate yourself for your own career. And I think that's 100% good. You want to be invested in the company that you work for. But the odds are that of those 10 clients, 8 out of 10 of them will be wrong. And they will underperform. The hard part sitting in our seat is the 2 that are right. And, they're the ones that, there's some advisor out there that told their NVIDIA executive client to exercise their options and sell their NVIDIA stock in 2020. And now, they're feeling pretty bad about it. But the odds are you don't know what the next NVIDIA is going to be. And the outcomes are so catastrophic. And even in that case, that client that sold that stock, yeah, he left a lot of gain on the table. It was really unlucky timing, but he probably still was able to secure his retirement. And that's so much better than clients that held AIG stock in 2006, right? For the same reason.
Yeah, and that ability to secure your retirement, right? So what are your goals? What is the lifestyle you absolutely know you could have if you have a diversified portfolio today? And then trying to really be realistic, you're holding out for what potential upside, like what difference is that going to make in your life versus the potential downside, which could be a drastic change in the lifestyle that you're used to living. And that's the thing that I think we try to educate people on and really help them understand. But you're right. Ultimately, it's their money, and we will do our best to help people make smart, informed decisions. And then as we're doing with our listeners or watchers here, and then you get to decide how much risk do you want to take. I just think people don't really understand the risk in many cases.
No, it's almost impossible to model. So, like, as you know, risk modeling in our industry is typically through Monte Carlo stress testing, right? And the statistics behind a Monte Carlo, it's not designed for financial advisors. It's just commonly used. But the math is all based on what's called a normal distribution, a bell curve, right? It looks like this. And so we put in an average rate of return, and then we have a standard deviation. And so then it's going to run a bunch of simulations that all kind of live within that curve. The challenge with any individual stock is it doesn't live in a normal distribution at all. Even the market returns in general are not normally distributed, right? Most of them are like -2 to +2%. That's an average market day. Almost none of the long-term outcome is in that, 80% or so. It's all in the 10% tails, right? And so, I can't sit down and look at any individual stock and build a stress test that's reliable, because of that. The randomness is just too great.
Well, you can't, but you have actually come up with some really unique ways, I think, to model some of that out. So I know we've had a lot of conversations internally around, if I'm running a standard like percentage of success, probability of success, but, 30% of someone's portfolio is in this single stock or a single real estate holding or a single business entity. Well, I can't run that through a standard Monte Carlo. So I think you've pulled the asset out and then run it without, or you've had a way of incorporating that. Tell me a little bit about that.
Well, there's a lot that you can do. I think the most useful thing to do in the context of a financial plan is actually take the individual position and assign a rate of return and run multiple versions of it at different rates of return, or even different sequences. So like this is a great example of clients that have stock options. And one of the biggest mistakes people will make as they approach retirement is in their financial plan, they will only include in that allocation, that rule of thumb that you talked about, the vested stock that they have sitting in their account. What they don't include is all of the income that's tied up in restricted stock units or stock option exposure, or even your salary and your bonus. If your stock price isn't doing well, you're probably not getting all of those incentive compensation pieces. And so, what I tend to do is take like the present value of those, or like even unvested options. They all have intrinsic value on the statement when you export them. You can include that as a base to get a true understanding of your exposure. And then I'll run it out and I'll say, okay, let's say the stock earns what it's earned over the last 5 years. And how does that look at a baseline? Okay, well, now let's say it earns negative 10%, or we look at the individual drawdown and say, all right, what if that happens? What if it's negative 20% for the first 3 years? What does that look like? And so you just get a better landscape of how things look. And sometimes the right outcome isn't necessarily divesting everything. Sometimes it's taking that exposure down slowly, right? I'm going to exercise more options this year instead of waiting until their expiration date. I'm going to sell some of my stock now, but maybe I don't get down to 10 or 5%. Maybe I get down to 25%, right? And over time, you can continue to make decisions. And so, that's a starting place. I think that's the short term, right?
Yeah.
Then you also have to look at the long term, which we could talk about as well.
Yeah, and what crossed my mind is another strategy I've used on a few occasions is a covered call strategy. So, somebody had a concentrated stock position. They, weren't sure about exiting out, but you're able to. We worked with a local company in town that would write a strategy. Covered calls are a form of options. And so basically you're receiving income. You're selling somebody the right to call that stock away from you at a specific price. And that price is set a little bit higher than where the stock price is today. And you can strategically set those prices. So, the stock might get called away if it's 5% above today's price or 10% above or 20%. And so you set these certain price points at which you would be willing to part with the stock. I like that strategy because it allows you to earn a little bit of income along the way. You are being very disciplined. You've already set your price points around, here's where I'm willing to part with a stock. If something drastically changes, you could close out those covered calls. So if there were covered calls still out there and you didn't want those to execute, you do have a way to close them out. You have to be willing to pay the capital gains tax as that stock is called away. And I think as you brought up, that becomes a major inhibitor, a major reason why people hold concentrated stock.
Oh, yeah, especially in today's market environment. And, it's one of those things that it's almost a pet peeve of mine. Because if you're 50 and you say, okay, I don't want to pay the capital gains, well, there's two ways to approach that, right? One is that, okay, well, when the stock sees a 30% drawdown, I'm going to call you and say, well, now's the time to sell. You're going to pay a lot less in capital gains, right? Well, nobody's going to do that, right? So the only way you can sell high is also paying a little bit of tax. The other issue that I have is you're always typically kicking the can down the road. The only true way to eliminate capital gains, permanently eliminate them, in a non-retirement account is the step
die.
up. Exactly. Yeah, true. Very.
Unfortunately.
That's exactly right. And so, in order to target a step up in basis, even if let's say, you're helping your parents with their finances and they have a big single stock position, it's one of the hardest parts for us. If a client is, say, 78, well, that's technically average life expectancy. That client could live to be 98, though. Any stock that you hold for 20 years, like any taxable gain that you have could be wiped away. And the truth is there's a lot worse things in life than paying 23.8% federal tax. I understand clients that, are executives and have blackout periods. They have to retain exposure, a lot of the time. I understand clients that are in the top tax bracket in high tax states. So they're going to pay 37%, plus potentially 10%, 12%. To state, that can make, the calculus a little more favorable to hold and retain that risk, but you have to have an end game.
Yeah.
For a lot of people, when we run these plans out, maybe you're going to pay 23.8% federal this year if you sell. Well, maybe 3 years from now, you're in the 15% bracket. And so a lot of the math we'll run is, okay, well, if you save 8.8%, and just to break that up, that's 20% long-term capital gains and 3.8% net investment income tax. Well, if you can save by waiting to be in a lower tax bracket a few years from now to sell, what would happen to the stock price, right, to offset any of the tax gain? And oftentimes it's not a big move. If the stock loses 5% between now and then, you offset the entire tax savings.
Yeah.
And it just, like, the juice isn't worth the squeeze. I have had cases where a client's going to retire in 4 months and they'll be in the 0% tax bracket. Well, that's, a wider margin, but you've got to be able to quantify it.
Yeah.
And I think it's exceptionally hard, but once you start putting numbers to it, back to risk and reward, it's a lot easier to figure out what the reward is. The idea of kicking the can down the road forever, though, until you get a step up in basis, remember, the longer you wait to sell, the more likely you're going to have a negative outcome compared to a broad market, well-diversified portfolio.
Yeah, and of course, you're not going to get the step up in basis. It's going to be your heirs. And I know we were kind of joking around about, the only real way to do that is to pass the asset along. But there's also charitable trust, right? So there are some ways that you can avoid the capital gains tax and trade that in for a stream of income, but you're not retaining control of the asset in
Right.
those cases.
Yeah, and we can walk through all of those strategies because there's a few for those clients that I mentioned, those people that have to retain that market risk, or what are the options outside of just paying the tax? There are several, absolutely. And so the charitable trust is one, if you're charitably inclined. And what I like charitable trusts for, a lot of the time you get an upfront deduction, but you can also structure them so you maintain income, liquidity. And there's always a constant balance when you're holding an individual stock position and you want to de-risk between liquidity, strategies that will give you liquidity without having to realize the tax, and strategies that will give you price protection. But there's very few that'll give both. And so, the hard part with the charitable trust is you actually have to want to give it to the charity though.
Yeah.
And so
Yeah.
if you really need like 100% of that balance for spending, it's going to be very difficult to employ that strategy. But for clients that are charitably inclined anyway, it can be a great resource to save on taxes, or even just gifting the stock directly to the charity.
Yeah.
Or using a donor advised fund. Those are all ways to shift those capital gains out and de-risk your portfolio without that tax event.
Yeah, and I was thinking more of some of the charitable CRATs and CRUTs, annuity trusts specifically, where you donate the stock and in return you can have a set percentage of the value as an income. The remainder goes to the charity. We're not going to get into the details of these strategies.
Episode, yeah.
That is a full episode. But no, there are some things out there, like you said, if you're charitably inclined anyway, if you need cash flow from this asset. And if you think about an asset, I just saw one in a portfolio the other day. It was worth about $200,000 and the cost basis was just over $1. So it was kind of crazy. So think about that on steroids, right? You might have, $2 million of an asset that only has a $100,000 cost basis. Well, in that case, if you wanted to donate a substantial amount to charity, you're going to get a percentage of that donation back as a stream of cash flow on the full donation amount, though. Well, there's a calculation that determines how much they use, but it's not minus the taxes, right? Whereas if you need the income off of it, you're going to take a haircut on every share you sell. So if the capital gains are large enough, there can be some strategies that can help you or you not pay that tax up front. But I think you have a certain opinion on that, and maybe one of the most overlooked strategies.
Yeah, well, it's probably not a surprise to people listening to this whole episode, but I think selling and paying the tax is the most underrated strategy. Because people want to have their cake and eat it too.
Yep.
And, just like I've mentioned before, the numbers oftentimes work out the best when you test all of those things. Every strategy that you overlay to defer taxes. Now, notice I say defer taxes, not eliminate them. If you're just deferring taxes perpetually, you're paying money for it. And that all comes out of the rate of return. It might not show up on your statement, but for even a charitable trust, guess what you're doing? You're hiring an attorney to draft the trust. And you're hiring an accountant that knows how to deal with the math, because the math is really, really important with the charitable trust. If you break the formulas, this has actually happened. Like for an annuity trust, it's designed to pay out a certain amount each year. If you don't invest that trust properly and you can't make the annuity payments for long enough, or there's not enough left for the charity at the end, you have to pay back everything. It's not a fun outcome, right? And so, the ramifications of mismanaging some of these strategies is really, really important to consider before you pursue them. And even option strategies. I mean, there are some really astute investors that can learn how to do like what's called like a basic options caller, or, they can hire somebody to do a covered call. But again, like doing an options caller strategy for a year or two before you maybe pay less in gains is a lot different than I'm going to do an options caller for the next 15 years. It's very costly to do that. And if you make a mistake on the trading, there can be big issues there as well.
Yeah, I think the cost and just simplicity factor, the administrative factor, is often overlooked. So in a lot of these strategies, there's fees, like you said, for attorneys, there's accounting fees, and there's simply the additional administration, in terms of time and keeping track of that all. And when I think about most people who get into their retirement years, maybe early retirement, they want to do all of that. But as they get into their 70s and early 80s, they don't want to have to keep track of all of this administration situation and a separate tax return and a separate account and a, separate set of fees. And then that attorney retires who was handling it. And then that accountant retires who was handling that piece. And you're in the middle of finding new people to do all of that. That can be really cumbersome. So that's where I agree with you. I think sometimes just paying the tax can be a wonderful strategy, as painful as it may feel.
Absolutely. And so let's look at those cases where it does make sense to retain the stock risk, right? Maybe the client doesn't need the liquidity from the position and they can actually wait for that step up in basis. And one note on that, I see this missed all the time. It's really important in retirement to know whether or not you are in a community property state or a common law state. And if you're in a community property state, your spouse, if you're married, at first passing, you will get a full step up in basis on all of those positions. Even in a common law state, I believe you get half. And so just know it's not necessarily joint life expectancy either. I've seen cases where, one spouse falls ill and, based on everything else, it would make sense to realize those gains. But because of the unfortunate medical circumstances, it actually made sense to retain the risk.
Yeah.
And so those are always positions where you don't want to have to be thinking about money in those positions, but we ultimately have to.
Our job.
Yes. And it can, be beneficial financially to be tactical in those cases. But anyway, I digress. So, back to those clients that they're going to have to retain the risk. I think the first step is deciding, well, how long? Like, what's the end game? Are you going to hold it for 5 years? Do you not have an end game in mind? And once you decide, okay, am I waiting to sell it until I retire, where I'm no longer in service as an executive and subject to the blackout periods, or I'm going to target some kind of charitable giving strategy? Like, once you know that, then you can start looking at the tools of the different option strategies. Other than the covered call that you mentioned, what other options are available for people that maybe aren't ready to sell that stock yet, but still want to hedge?
There's exchange funds. And so we've looked at some of those for our clients where you contribute the stock. In return, you get ownership in a basket of stocks. There's often a certain holding period. I've seen 7 years. Of course, there's going to be fees at the level of management for the fund, but that can be a way to diversify. You're also deferring the capital gains. So you're contributing the stock. You now own a piece of a basket of stocks. You have to be aware of the diversification in that portfolio. So what other concentrated stocks were contributed to that exchange fund? How diversified is it? What is the holding time? How long do you need to maintain it? But you're just deferring the tax. You're just putting the tax or kicking the can down the road, but with less risk from a concentrated stock position. So that's one of the advantages, right? Yes, you're still going to have the tax, and if this diversified portfolio does over time, does well, you're going to have even more tax, but you have less risk. You're not taking so much downside risk in that situation.
Yeah. Well, let's evaluate some of the practical nuances of exchange funds because they're super popular right now. And anytime you see a market where you have large cap concentration, like it is, where the biggest stocks are driving all the return, exchange funds are always in the news. And they're always really popular because people are trying to, defer the tax, but de-risk, right? Because they're worried about the valuations of what they hold. And so what you need to know about exchange funds are that they're ultimately limited capacity. So in order to create the diversified index to get the tax status of tax deferral, what you have to do is basically say, okay, we're going to have, we're going to match an index, call it the Russell 3000, or even sometimes it's like the NASDAQ, right? They can pick one. And then basically they're going to accept every stock that's in that. And they have to accept only a certain amount of each, to match the proportions, which means there's not an unlimited seat for people with NVIDIA or Apple. And so oftentimes what you find with those, funds is that it's really easy for them to acquire the stock that everybody has that's doing really well. It's very difficult for them to acquire the stocks that aren't. And because of that, they're, very hard to get into. And so you end up in a position where, like, if I'm an exchange fund provider, I can't just keep making a new one every single year or every 6 months to accommodate the people with Apple and NVIDIA and Google, because I need to go find Dr. Pepper and Intel and all these stocks that people aren't really holding, in concentrated ways.
We just had a case. So we had a case of a new exchange fund that was coming out, and a client that had $1 million of Apple stock that we were going to contribute to this exchange fund. And the exchange fund ended up not rolling out because they got so much Apple stock and so much of the Mag 7 that it wasn't diversified. And if they couldn't meet a certain set of diversification criteria, then the fund couldn't roll out. And so I've encountered that in real life in the last 12 months.
Yeah, there is a company called Cash that's out there that has been, raising quite a bit of capital to make exchange funds more accessible. But let's say you get lucky and you can get in. Well, then there's other implications, right? And the biggest drawback is the one you mentioned, Dana, which is the lockup period. Yep. So when you enter an exchange fund, you are basically saying, I'm not going to take a withdrawal from that portfolio for 7 years at minimum. And that's not where it ends, right? Because like you said, the gains don't go away in 7 years. Yeah. What ends up happening is you get a basket of stocks back. Yes. And you have no control over what those stocks are. So when you do decide, at 7 years is up, now I'm ready to do that, your cost basis actually stays the same, but now it's spread out, across a few companies or maybe 2 or 3 that you don't even necessarily want to hold. And then you're exactly where you were, 7 years ago, basically.
Yeah, well, maybe a little bit better off, right? Because you have a basket of stocks instead of one single stock. But still, yes, you now have to find a plan to sell off that basket of stocks that you got back, and you're still going to have the taxes and, your tax rate. Well, that we don't know for sure, but, you can model that out and kind of see if it's likely to be just as high or, potentially even higher than when you started the whole process. You never know.
Yeah. I mean, relative tax rates matter a lot. Like it's very recently that there was a proposal to increase the capital gains rate to match the top ordinary income rate. I don't see capital gains taxes getting lower in the next 30 years. They can happen. Nobody has a crystal ball. But, I've never once seen a proposal to lower capital gains rates from where they are right now.
No, I think it'd be very hard to do. I'd make the 0% rate apply to everyone.
Yeah, make it larger.
I don't think we're going to see that.
No, I tend to agree. Well, the best way to get a 0% tax rate on your earnings is to invest in a Roth.
There you go.
If you're able to.
Yep, absolutely. I thought you were going to say the best rate to get a 0% capital gains rate was to lose money. Like, no, that's not the way. But yes, that would work too. Not what we want to do.
So we talked about exchange funds, and then you mentioned covered calls. I mentioned collars. Have you ever implemented a collar before?
No, I never have. I've looked at them in a few cases. It usually came down to cost. So, you mentioned administrative costs earlier, but if you're employing an option strategy, there's a lot of cost to writing puts and calls. And so the cost made the whole strategy ineffective. You're looking at, wow, like, am I going to pay, I can't remember the exact percentage, but like say it was 3 or 5% a year of this asset value to protect the asset. Well, if it's 5% a year, over time, I've paid 20% of the asset value just to protect the asset. That just doesn't make sense, right? It just like, this doesn't add up. Now, if I'm a huge corporation, and this is where I think it's important to remember some of the articles you see in the news, some of the newsletters you might read, they may have a different audience. And so they have different investing goals, and there's certainly institutional reasons and sovereign wealth funds and other things where those kind of advanced strategies may make sense. But in the household cases I've come across, those strategies were often cost prohibitive. Can I say that right? Prohibitive.
Yeah, I tend to agree with that. There are certain options trading desks, especially with big stocks, where it's becoming a little more efficient. And for people that aren't familiar with the collar, basically what you're doing is you're creating price protection, by doing, you basically, so the best way to buy insurance on a stock is to buy a put. It's the right to sell that stock at a certain price. So if I have a stock that's trading $100, I buy a put for a strike price of 90. If that stock drops to 50, well, guess what? I get to sell it at 90. The problem with a put is it's very expensive. So what a collar allows you to do is then you write a call. You give somebody else the right to buy the stock from you at, say, 110, right? So if the stock goes better than 110, well, you lose the upside, but now you're not paying so much for the insurance. And so you're trading upside for price protection in a way.
Yeah, and let me just clarify. You are still paying the same amount for the put, but you have income you received for selling the call that helps offset the cost of the put.
Exactly.
Yeah.
Yeah, and so it's just a strategy to make it more, cost
More
efficient.
cost
Yeah.
efficient. Yeah.
Because if you could just buy a put on it, right, then everybody would just do that
Yep.
if it made sense. And so I think those strategies can make sense in very isolated scenarios and usually for a short period of time. Like I had a client that was an executive and he was going to get to retire, so his income was going to go down and retain his stock options, which meant that he didn't have to vest. He didn't have to exercise them automatically. Many executives are not in that position. When they retire, they get a 6-month window to exercise all their options, or I've seen it as short as 3 months. And so this particular client though was able to defer for up to 8 years the
Wow.
exercise. And that means he could exercise strategically. So instead of looking at filling up low tax years with like a Roth conversion, we said, well, what if you exercise the stock options, which is ordinary income, instead of capital gains, and basically, spread that out instead of doing it all in 1 year. Well, the challenge with that is even though you spread it out, options are an even more accelerated risk to an individual stock. If the stock does really well, you're getting, multiples higher than if you just held it as an individual holding. But that being said, they can also be worth zero.
Yes.
And so
Yeah, that was that model I tried to create for my client to illustrate, the upside and then how it flattens off and, they could also be worthless.
right. And so, our conclusion was that the tax savings weren't worth the market risk. And, he could employ a caller to, kind of create a bridge to the first year or two of income savings. And that could make sense if he was able to, structure the collar in a way that was cost efficient.
Yeah.
But even that takes risk. When I talk to clients about kind of the order of operations of divesting from company exposure, exercising options is always usually number one on my list. And it's because not only could they be worth nothing, but you also have an expiration date.
Yeah.
If I have just an individual stock in my portfolio, maybe it's from a vested RSU or just something I bought a long time ago, I never have to sell it. But if it's an option, let's say even if it is an 8-year window, well, if in year 6 the stock doesn't do well, even if long term it rebounds, you don't have long term. You have 2 years to get that exposure exercised. And so I tend to say that's your first line of defense. Exercise the options now, and then you can handle the vested stock later.
Yeah, I like that. Well, I know we talked about covered call strategies, charitable trusts, exchange funds. Our favorite, just selling the stock and paying the tax. What other tax deferral strategies do you see?
Well, so there are some new shiny tools. I call them shiny because they're just brand new. I don't want to say they're brand new, but I'm sure they've been in existence, but they were never efficient technologically to implement until just recently. And so there's one strategy called direct indexing that's become very popular in our industry. And then there are a couple of strategies that are kind of offshoots of that to help accelerate the benefits. And so what direct indexing is basically you have an individual stock, and instead of buying a ETF that has 2,000 stocks in it, like a Vanguard total market fund or something. You buy an exchange fund, or not an exchange fund, a direct index that basically has all the individual positions.
Except your concentrated position. So it's an index kind of built for you.
Exactly. Yeah. And the benefit of that is, just like the research we've quoted, on any given year, most stocks will be down and the winners will be winning a lot. And so if you do that within an ETF, well, you just on your statement, in your brokerage account, you have a cost basis for the shares of the ETF, and you don't have exposure to the individual gains and losses. But when you're in a position where you have a direct index, well, now you can basically sell the losers and buy, or you can sell the losers and sell the winners to offset the gains and the losses over time.
Or you can sell the losers to offset and create a capital loss to offset the gain on selling your concentrated stock position.
Exactly. And so the idea is you can divest, while offsetting the tax liability. And it can work, but there are trade-offs.
Yeah, I've looked at this in the last couple years. And so one of the challenges that I had with it is, again, it felt like I was just kicking the can down the road. So you could generate a lot of losses, potentially, I should say. I was trying to get some stats on like just historically, give me an average. Like if I had $1 million in this portfolio, could I generate $60,000, $80,000, $100,000 of losses a year so I could see, how much of this other asset would we actually be able to sell? Well, coming up with those numbers is hard because nobody knows year to year exactly what the market's going to do. And so that became one aspect, just the uncertainty of it. But even if it works, right? So I was able to generate losses, but the other stocks in the portfolio went up, and so I had a positive return even though I generated these tax losses over here. Well, in the end, I'm still left holding a concentrated basket of stocks. Now, it's a little more diversified than maybe some of the single stock that I was able to sell, but I still have a concentrated basket of stocks that all did well recently, and I have an embedded tax implication in those. So I was like, well, yes, this could help for a while, but eventually these assets have to get turned into a source of cash flow for retirees. In most cases, we need to use them. And so it just felt like kicking the can down the road to me. I don't know if you feel the same way.
I do. I mean, oftentimes what you see with a direct index strategy is that over long periods of time, there are no more losses to
Yeah,
harvest, right?
exactly.
And here's how it works mechanically. It's not that you're selling forever, right? If a stock is down, you don't want to lose exposure to it, but you can't buy it back for 61 days.
Yeah.
And so the challenge is that you have what's called tracking error in those 61 days. And just like we see oftentimes, like we talk all the time about how the best days in the market and the worst days in the market drive most of the outcome. Well, what's also true is that the best days tend to follow the worst days. So if you sell on the worst day of an individual stock and then, a week later something happens and it recovers, well, you just harvest it out and now you can't buy it back and you missed out on the recovery. I don't think that tracking error is worth the tax benefit. And then you end up like locked in. Like one of the benefits of an ETF is they can trade and rebalance and it doesn't impact you. Mutual funds aren't quite that way. Mutual funds, that gain will flow through to you. But ultimately with an ETF, that's why they're so valuable, is because it doesn't in a taxable account. So you get rebalancing, you eliminate that tracking error for the lifelong, holding of the fund. But with a direct index, you don't get that.
And the offset I've heard to that by the people who are doing the direct indexing, right? So they have a bit of an incentive maybe to promote it, but is that, they can somewhat reduce that tracking error by owning similar companies. I've heard the Pepsi and the Coke example used quite a bit. So, yes, maybe Coke has a loss and so they sold it, but they still own Pepsi, and over time those should move in about the same direction. But yes, it's still going to cause tracking error.
Yeah, and well, the hard part is they don't. Like it's owning sectors is not the same thing as owning companies.
Yes.
It's why it's better to just, in my view, own all of the companies that you can,
Yes.
and so that's ultimately why direct indexing, I rarely recommend it. I think it can be valuable in a case where it's not all or nothing. Like maybe you have $500,000 of your assets in direct indexing to generate some tax losses, but then you have $1 million in the ETF version of whatever you're buying, so you still get the exposure, right? That's more of a moderate approach than I'm going to take, this giant taxable account with most of my assets and put it in a direct index. So again, it comes down to like, what's the end game? And are you making investment decisions for a tax reason, or are you making investment decisions for an investment reason? And in my view, over the long term, if you're making an investment reason for a tax reason or a decision for a tax reason, you're going to end up behind.
Yeah, and it's so interesting because, I started my career at a small, firm that sold mutual funds and insurance, and then went to a major brokerage wirehouse, and then spent 4 years with a CPA firm, a broker dealer that worked with CPA firms. And as you were saying this, what came to my mind was all the, wholesalers that would come in and talk to us in these lunch and learns and tell us about this latest strategy and that latest strategy. And there's a lot of complexity, and many of these things sounded so cool, right? You're like, oh my gosh, like I could do this, I could do that. But most of them were designed to sell products to people. They involved a lot of complexity, which made it sound like, you're part of the private elite wealth group, you get these fancy strategies. But in the end, it's really hard to see that any of them deliver much more substantial value than a much simpler approach. And that's really exactly what you're saying, right? Is people overlook sometimes the simplest option and jump through all of these hoops and fees and costs. And I experienced it by being on the receiving end of just constant wholesalers coming in, trying to show us the latest and greatest thing to show our clients.
Yeah, and I mean, look, there needs to be innovation, right? And so we're not opposed to considering all new products. We actually kind of nerd out on that. When we hear new things, we want to be on the forefront of that innovation, but we just have to be really cautious about what's sustainable and what's not. And anytime you're, investing in something new and shiny, the first question you should ask is, will that product even be around 10 years from now? If you're building a 30 plus year retirement plan, it needs to be a sustainable vehicle.
Yeah.
Because if it's new, there's nothing to backtest against. And the second that, the product's no longer profitable, you don't know what the outcomes can be,
Yeah.
especially if you have somebody, with conflicts of interest selling it to you. I'm reading Bob Berry's new book. He's an industry consultant. He's been around forever. He's seen, the entire evolution of the financial planning business. So, somebody I look up to quite a bit. And he wrote like a 700-page memoir
That's
about the history
crazy.
of the financial planning industry. And it starts with him. He was not an advisor. He was the editor of Financial Planning magazine back in the 70s and 80s. And in the 80s, they were selling these limited partnerships. And back then, the tax code was written so that you could, if you bought this limited partnership, you could actually eliminate taxes.
Yep.
The challenge is that they were private investments. So you'd put capital in a pool. They weren't publicly traded, so you didn't know exactly where the money was going, and they were rife with fraud and mismanagement. And so then a lot of them failed, and they completely blew up over time. And then all those tax benefits actually went away, and investors had to pay the tax afterward.
Yeah.
And so, when you hear about those stories, we have recency bias of our own where we think, oh, these direct indexing strategies, or, we'll talk about in a minute, or long, short direct indexing. It's a more extreme example of that. Like, let's put all of our clients in there. That sounds great. But you have to step back and just wonder, okay, what is the long view here?
Yeah.
Because for every great like ETF-like innovation, there can also be ones that, don't end up panning out like people intend. And it's not necessarily out of ill will. It's just that's the marketplace. Not every cool idea is going to ultimately work.
Yeah, and I think most of the ideas have a case situation where they are very appropriate. So it will be like, okay, in these circumstances, yes, absolutely, this would be a really good fit. And then, 98% of the situations where you go, no, that wouldn't really be a good fit. And so that's where you have to really understand the nuances of the strategy or product or, what I want to call it a tactical strategy, whatever it might be, to say, okay, where really would this add value? And oftentimes it's not in every situation. It's in a very limited case.
Yeah, I had a client when Opportunity Zones came out in the Tax Cuts and
Yes.
Jobs Act. This was
Yes.
back in 2017. And the client goes, well, I heard I can invest in this project, and after 10 years, it'll be tax-free, all the gain. I'll get it all back. And I said, that's great. Well, do you want to invest in an inner city real estate project? Like, would you do that if you were ignoring taxes? And the answer was always no. And so it's another example of, okay, don't go invest in something you don't really understand or want to invest in when there's high risk, just for kind of the carrot of tax-free. And the program was actually invented for developers that know what they're doing in real estate to invest in those communities, not for every retail investor to try and get a free tax ticket.
Yeah. Yeah, that makes sense. And I saw the same thing with the CPA firm, with equipment leasing, oil and gas partnerships, things that promise big tax benefits up front. But, did that really make sense in terms of the client's overall portfolio? Was it a good investment? Forget about the taxes, taxes aside, was this a good investment? That's what you have to ask.
Absolutely. So one thing that I've been seeing, Dana, lately, and I've seen it before, I'll frame it like this, that a lot of clients will solve the liquidity issue of a concentrated holding with margin. And the idea is simply this. You can pay margin interest, take money out, right, and then spend it. You can even take it further. You could take a very large margin position and borrow against your individual stock and buy a diversified portfolio with it. And so when it comes to direct indexing, you can also do the same thing. You can buy an index, and then there's what's called a long-short strategy, where you go basically, you take 30% margin on it and you short a bunch of stocks to create artificial losses. What is your opinion on some of these, I would say, more extreme strategies that require leverage and not just traditional options?
Yeah. I know we're in the middle of evaluating one of these strategies right now to see if it would be appropriate for some clients that have concentrated stock positions. And so I haven't done a deep dive on it yet. Initially, whenever I hear leverage, it's frightening. At the same time, if you look at some of the, largest and wealthiest people in the world, all they use is leverage. But you're talking about a whole different scale, right? If you're worth 100 million, if you're worth $1 billion, and you have, at that case, probably a lot of concentrated positions, usually your business, real estate. Well, the only way to get liquidity is often to set up borrowing means against these assets. When you're talking about the average person, $1 million, $2 million,
Even up to 10 million.
even up to 10 million, these strategies are complicated, They can be hard to understand. They can come with a 50-page document that, we're reading through, just making sure we understand all the nuances. There can be high tax consequences to the income produced by some of these strategies. Um, and leverage itself, I wouldn't mind leveraging a diversified portfolio. So when I think about like leverage against a direct
Yeah.
indexing strategy and it's a 30% leverage, I'd actually feel pretty comfortable with that.
Yeah, it's definitely a totally different analysis. Like even if you have a concentrated position in like the S&P 500 index fund and there's a bunch of gains, that's a lot different than owning any individual stock in that index as far as how you should calculate the risk.
Yeah. Leverage against an individual stock, far, far riskier. And, there's always the cases where you could say, well, 30% margin against this stock, of course, that's always going to be okay. But there are many times in history where it was not. And it's back to some of those forces, that can come up. Competition can come up that no one ever thought of. A brand new technology could make whatever that company does obsolete in a matter of years. Fraud can come up. Really bad management. So, there's all kinds of things that have taken down really solid companies in the past. And so I'd be pretty cautious about too much leverage against a single stock position.
Yeah, well, I mean, what I compare it to is it's like you want to do a home renovation and you go take out a second mortgage. But let's say your mortgage is the second one significantly high, right? It'd be like if your bank can call you and say, you know what, I want that mortgage paid off tomorrow, right? Because that's what margin loans are. It's
Yes.
if the stock goes down, right? In that
Yes.
scenario, if your house goes down, you're in a position where, well, I'm just going to live there and continue to pay the mortgage and hope that there's a recovery like 2008 or, occasionally you could walk away, if you're in a non-recourse state. But, ultimately, I know you have a story about that. But ultimately, the bank cannot come to you and say you have to sell your home to pay us back. Whereas with a broker, if you're taking on margin and you see those systemic crashes, like 2020 even, it can be a very short period of time. It's not the same calculus as, oh, I'm just going to wait for the recovery. You get called, you have to put that money in that account to shore it up.
Yeah.
And on top of that, you're paying interest to do it.
Yeah.
And so even on a diversified portfolio, you have to ask, okay, if the goal is to reduce taxes, and exit the position and save, again, is it 8% on your taxes? Is it 20? Is it really like 3.8? Is it small? You have to ask, okay, is the interest worth it? And is the risk worth it? Because even if you're offsetting, some of the margin risk with the options, ultimately, if there's a big systemic crash, like your debt line, whatever you've margined is still static and you
Yeah.
can get called just like anybody else.
Yeah. Now, wait a second, though. I got to go back.
Yeah.
Can't the bank make you sell your home? I mean, foreclosure, right?
Yeah, if you're not making your payments.
Yes,
Yeah.
okay.
But it's
As long as
different.
you're making your payments,
Yeah,
yeah.
it's totally different than a
Yeah.
margin call.
Yeah.
Yeah.
Yeah, completely different. Yeah. And so I was thinking as you were talking about recency bias, right? And then a different kind of bias. I actually wonder if there's a term for it, but let's say you've been through something really traumatic, like the Great Recession. And myself, having been through some really traumatic situations with clients, I wonder sometimes if that makes me biased. And so the one that came to mind was a client that went into the Great Recession with a significant amount of margin. They were building a home, a very expensive real estate project. And I remember, had done their financial plan and said, look, like this only works if everything goes right. And that scared me. But they were, very, wanting to take that risk. It was like blinders on, we're doing this. And so they entered the Great Recession with margin loans. They got the margin calls. They were constantly having to come up with cash to deposit into the account to cover those margin calls. It was terrifying. And so that has probably impacted my feelings about leverage. I do think there is a time and place to use leverage. We're big fans of pledged asset lines of credit, for example, against a diversified portfolio of assets that can be used in real estate transaction purchases. It can be used to buy a car. There's other reasons where you might use something like that. Usually temporary financing is what we're using them for. But in terms of, leverage as a permanent lifelong strategy, it makes me really nervous, especially when it's against a concentrated asset. Going into the Great Recession, it wasn't a concentrated asset. It was leverage against a diversified portfolio. It was reasonable amount of leverage, but it didn't matter. The market went down so much that there were constant margin calls, and it's not a pleasant thing to go through.
Well, I go back to the end game, like you mentioned, pledged asset lines. Security-based lending, there's nothing wrong with employing it as a tool if you know what your end game is. It's just like we were talking about at the very beginning, right? If you don't know what your end point is and you don't know how you're going to pay off that line, then it does become in perpetuity.
Yeah.
And it's like you get to a point where your debt is controlling you. People don't think about margin like a debt, but imagine if you put that much on a credit card, and ultimately if you're borrowing to spend on things you can't afford, that's the result. But that said, we have had plenty of clients with success stories. Like a great example is bridge financing. If you're going to go buy a new house and you haven't sold yours yet, great example of that position. But even then, if we have a client that needs to max out their available line, right, where they can't withstand a little market decline, that's an issue. Usually, we're not borrowing even up to 50% of the available credit on those for those situations. It's more the bank's going to give me a loan for X, and borrowing against my securities, it's a little more risky, but it is a lot cheaper.
Yeah, and there's a difference in that case. We're using the portfolio as collateral to, buy something that's not in the portfolio, versus technically margin itself is using the portfolio as collateral to buy additional securities. And so that is a whole additional layer of risk that is, I think, what you're talking about with those long-short strategies, right? They're margining the account and then they're shorting the stock.
Yeah, that's exactly right. And it's just, again, it's the idea of, okay, well, the end game is to take your highly concentrated individual stock in a direct index, over time diversify. Well, somebody said, well, if we used options and leverage, we could diversify sooner. And so, like, I've read those strategies are only meant to last 5 years. It's just a question is like, okay, what if the 5-year period is really awful? And by the way, a lot of 5-year periods in the market are really awful. There are plenty out there, and so is the juice worth the squeeze in retirement? Again, like that's the aim of the show. We're trying to talk about stable outcomes, not maximizing returns. Every strategy that we're evaluating the pros and cons, and there's somebody out there that's done it and they've done great, and they're listening going, these people have no idea what they're talking about. I did it. My uncle did it, right? That's why we look at data like this, because it gives us an aggregated view, and that's really what a formal professional process is all about.
Yeah. How do you create a more predictable range of outcomes, particularly when this is your nest egg? You need to live off of it the rest of your life. That's a whole different parameter that you're looking at than, some of the one-off strategies that random people can encounter.
Well, we've covered a ton today. I think that's a great place to wrap. Thank you all for joining us. We really, really appreciate it. And we hope this episode helped you make sense of managing concentrated stock positions in your retirement.
We hope you enjoyed this episode of Making Retirement Make Sense. If you found it helpful, please like, subscribe, comment, and share it with someone who you feel could benefit from what we discussed today. And if you're feeling extra generous, we'd welcome a review on Apple Podcasts or Spotify.